On this channel, we have a different mindset from many investors and other channels on YouTube. We are not happy when stocks go up. Yes, it's cool, yay, I made $100 today, but no, it is not fun when stocks are going up. It means I can't buy more of the businesses that I love to invest in for their qualitative and quantitative features at lower prices and get more of an ownership stake. Personally, nothing really gets me more fired up than seeing an amazing business that nothing changes with its actual business fundamentals having the stock price go down. Yes, it's cool and nice to see that your investment thesis can be paid off in the short term, but a lot of people get happy over short-term performance. So today, I'm going to be sharing two dividend growth companies in my portfolio at the moment that I have an eye on regardless of the high valuations and the S&P 500 trading at all-time highs. But before we get into that, check out the Do Dividend Stocks Not Drugs merchandise, the best merchandise for any dividend investor. An amazing way to not only get a really comfortable t-shirt, but also help support your favorite finance channel that doesn't like to show 1 month performance every single month and prefer to look on a longer time horizon, 10, 15, 20 years. That's real investing for me. Thank you, and of course, roll the intro.
Hello, I like money.
When it comes to looking at stocks and businesses that are undervalued in my portfolio right now, I think the obvious one for me at least is Vici Properties, stock ticker VICI. Vici Properties is a very popular dividend REIT, but I believe the quality of Vici and their properties and the advantage that they have over your everyday kind of REIT, I think it's absolutely legitimate, and there's a reason that Vici is one of the most popular dividend REITs right now. But the stock market has not been pricing Vici like the popular dividend REIT that it is, and it's been trading flat ever since 2021 pretty much. I'll say this, a lot of people have fair value on Vici at around $34, $35, $36. I believe as they continue to grow their business, grow their earnings, they'll only continue to go up. But obviously the big thing right now that is really holding REITs and utilities back right now is interest rates. If you guys didn't know, REITs and utilities use a lot of leverage, aka debt, to run their business. This is completely normal when investing in them. Now, a few years ago, Vici was really heavily concentrated in Vegas. Vici actually owns a majority of the Vegas Strip, and that's what it's most known for. But recently, they've been making a ton of acquisitions that are accretive acquisitions which will add to their long-term value and diversity of revenue streams. This will not only add security to the dividend, but also add future growth opportunities for Vici. A lot of people are hesitant to buy Vici because of how concentrated they were into the Vegas Strip. So if anything catastrophic would ever happen to Vegas, which knock on wood, never happens. Or let's say Ryan decides to go to Vegas when he's 21 and goes to the casinos and they lose all their money and have to file for bankruptcy, then Vici might be in some trouble. But that's what a lot of people were worried about because of how concentrated they were. But over the last couple of years, Vici has made so many accretive acquisitions outside of Las Vegas and across North America that really diversifies their revenue and also accelerates their growth. Vici's business model is also just really easy to understand. They collect rent from the tenant. They own the land that's actually on the Las Vegas Strip and all these other resorts and hotels that they own. And no matter if it's a good month or a bad month for their tenants itself, they're still going to be getting the rent. That's a very misconceptionized thing when it comes to Vici, is that they benefit from how, the hotels and resorts do in Vegas. No. During good times and bad times, Vici will be collecting that rent. Vici even collected their rent during 2020, and that was going to be one of the worst things that would have happened to Vegas, and they went through it just fine and increased their dividend during it. Speaking of increasing their dividend, let's go over to Vici's dividend growth, as that's a big reason you're going to be buying the REIT. Vici currently offers a 5.62% dividend yield. Recently, they increased their dividend this fall. It's 6.41%, which is really solid for a REIT. They have a 3-year growth rate on the dividend of 7.94% and a 5-year growth rate on the dividend of 7.62%. This is really quality dividend growth coming from a REIT that offers a 5.62% yield in the process. So I think as they continue to grow their business, continue to grow their operations, this dividend growth will be sustainable. I would be perfectly happy with a 5 to 6% dividend hike annually from Vici. That's really good for a REIT. A lot of people are turned off by that fact, but it's really solid combining it with the yield and it potentially being undervalued right now. Now, another reason some people don't like Vici is that they actually recently filed as an IPO, which basically means they're only a public company since 2017. So a lot of people haven't seen the long-term data yet with Vici, how they do during recessions, etc. So that's another turnoff. So if you like that long-term data, which I know some people do, Vici may not be the best stock for you. Now, something that's been brought up a lot recently is share dilution. And obviously, when it comes to utilities and REITs, and especially REITs, share dilution is completely normal. This is how they raise money to get new acquisitions, grow their business, etc. So recently, Vici's been doing a lot of acquisitions. They've been buying a whole lot of new land. So of course, they're going to be increasing their share count and diluting the shareholder. This is completely normal, and they're also going to be taking on more debt, but this is nothing to fear about if you actually look at their balance sheet and financials. So that's just wanted to clear that up. The next company on here is not known for its dividend or dividend growth, but it's still an amazing business in my portfolio that I'm going to look to add to regardless, and it's Apple, stock ticker AEPL. Now, I recently just made a video on Apple stock, and I highly recommend you go check it out. I go a lot more in depth of why I'm really considering the company right now at these current valuations. On Discord, I just quickly ran a poll. 2 of you guys said that Apple was at fair value. 4 of you guys, including myself, didn't think that Apple stock was overvalued, and 1 of you guys said that it was overvalued. So it's really interesting to see from the community itself whether you guys think that Apple is overvalued or not. Apple actually just recently announced that they'd be ditching their card plans, which I think is actually a good move long term for the business. The car business is not the best one to be investing in, but regardless, the Apple ecosystem and the brand of Apple is as strong as it's ever been. Now, people are questioning now whether they think that Apple stock is overvalued, and I potentially think that it could be in fair value. And you guys know me on this channel, I am not afraid of buying an amazing business at fair value, and Apple is an amazing business in my humble opinion. Unfortunately for you dividend-focused investors, Apple only offers a 0.53% dividend yield and pretty lackluster dividend growth, which I'll go over. So Apple's dividend is really weird. Its payout ratio is dirt low. It's practically nothing compared to their earnings and their free cash flow growth. But regardless, they've still not chosen to increase their dividend over time. Instead, they have chosen share buybacks. Recently, they hiked their dividend 4.35%. They're set to announce their new dividend increase in the next couple of months here, and I would assume it's probably at 4 to 5%, right where inflation is at. They're growing the dividend, but they could be growing it a lot more, let's just say. But they have chosen to reward the shareholder through share buybacks instead of dividends. I would assume this is better for tax reasons, but it's also an amazing way to give shareholder value. Buybacks, dividends, and all that good stuff comes from free cash flow, which is the most important metric in any business. Apple's free cash flow growth is really good. Their 3-year growth rate is 14.59%, their 5-year growth rate is 14.46%, and their 10-year growth rate is 13.85%, and it looks to not be slowing down anytime soon. Apple is such an amazing business, and it's a forever company in my opinion. Now, looking at this free cash flow, they could obviously increase that dividend a lot more than what they've been doing. If I had to make a projection, I would say in the longer term time horizon, I think Apple will start to aggressively grow their dividend once share buybacks aren't really feasible for them. But Apple's buybacks are actually historically incredible. Buybacks essentially give you more equity in the stock that you own in the company whenever a company buys back shares. It's also good for tax reasons, but it's a very positive thing to see. For the last 3 years, Apple has bought back at least 3% of their shares. 4 years ago, they bought back 5.7% of their shares, and 5 years ago, they bought back a historical 7.02% of shares. That's absolutely insane stuff from Apple. This is the reason Apple stock has outperformed as of late. Their management, leadership, innovation, brand power, pricing power are all quality characteristics in any dividend stock. And I think over the long term, Apple will continue to do buybacks, but I think over a longer term time horizon, Apple's dividend growth will eventually pick up at some point. I don't know when, I can't predict the future. I want to thank you all for making the video. I greatly appreciate the support on the channel as of lately. I'm catching up to all the portfolio review requests, so please give me a little time with that. I'm a little overwhelmed at the moment with all the requests, but I greatly appreciate you guys so much. Thank you all for watching. Smash like and subscribe. Check out the new Dividend Stocks Not Drugs merchandise, the best looking merchandise for any dividend investor. Thank you guys for watching and do Dividend Stocks Not Drugs. Have a good one.